16. You may notice in this class we move a little slow. It's because I'm more concerned with the depth of content than how much we get through, and we'll get through what we need to get through this semester. We're going to be continuing chapter 16 today about the securities markets today. We'll be spending some time reviewing it as well. I'm also going to be showing you guys how to use what I call a stock aggregator. What this is all about, guys, is how to track your portfolio. Now, we're going to have some guests in class this Wednesday. Career Services is stopping to pay us a visit. Now, guys, you may say, well, what's Career Services doing in Biz 101? A lot of you are early on in your college career. Some of you are freshmen. Some of you have switched majors. And we like to have Career Services come in and explain how they can help you get ready for the world beyond college. They're going to be talking about something called Handshake. Some of you who have me for other classes already have a Handshake account, but it's a networking tool to get jobs after college. And they're also going to talk about some of the services they offer. For example, let's be conversational today. Let's say you were going for your first job interview after college. What's a question that a potential employer might ask you? Anybody have a guess? What is something they might ask you? What do you think? Yes?
Previous work experience.
Exactly. I want to know what you've done work experience-wise. Well, what else might they ask you? What is a question an employer might ask? Yes? That's exactly right. And that's a tough question to answer, isn't it? Like if somebody said, and let's take it back a step. Let's say somebody said to you, tell me a little bit about yourself. That's an intimidating question, isn't it? All of a sudden you've got 15 to 20 seconds to say something really smart sounding that sums up who you are. Career Services will prepare you to answer those questions. They do things like mock interviews. I cannot overemphasize how important it is that you establish a relationship with Career Services. And on Friday, our rate of return exercise is going to be due. And I'm making an executive decision today. We're going to put that back to next Monday. That's going to be due. So you have the weekend to do it. You don't have to worry about it this week because we're going to cover it in class. I want to make sure you understand what that's all about. But guys, what I'm going to be showing you next is how to use a stock aggregator. What I'm also going to be doing at the end of class today, we're going to end class about 10 minutes early today, so that you guys can get into your groups. That doesn't mean leave. It means I'm going to get you into your groups and talk a little bit about your strategies, about how you're going to invest and how you're going to use something like a stock aggregator. I happen to use an aggregator from Yahoo. And I know Yahoo is kind of a dated company. It's something that we don't all use as much as we used to. But I think it's got some merit to it. In fact, let me record this. I am recording this for our posterity here. If you started a Yahoo account, you can easily set up what we call a Yahoo Finance account. Now here's the trick. If you really get into it, you can even associate your bank account with it and do trading, do real world trading. I don't have mine tied to my bank account because I use other apps for that. But, for example, we get into Yahoo Finance, you can set up portfolios. You can set up multiple portfolios too. For example, I've got a personal watch list and I've got one that I watch just for Business 101. So let's go into my watch list. Let's see what I'm watching these days. So all these are stocks that I decided to monitor, things I'm interested in, things I'm curious as to how they're going to go. Like one of the ones I've been the most curious about is Beyond Meat. BYND is their stock ticker. So I get a lot of information right from Yahoo in terms of how that stock is doing. So Beyond Meat, by the way, has anybody ever here had either a Beyond Burger or an Impossible Burger? Yeah, whether you like those or not, they're going to be big things in the market because there's a lot of folks who want to get away from eating meat who still like hamburgers. Well, let's take a look at Beyond. Let's see what this is all about. We can see right now, for example, that as the last day of trading, which would have been March 5th, at the close, this was going for right around $138.30 a share. Not bad. And we can look down here at some of this information. For example, we could look last Friday to see how we did. We started off the day at 9:30 with a reasonable amount, like we were at 136. We bottomed out in the middle of the day about 127, but we finished strong. Now here's the trick. Let's say, for example, I wanted to see how they do for the last year. I can click on 1 year and I can see, oh, they had a peak way back in September at $194 a share. So we're lower than we were at our peak a year ago. But we went down, we came back up. I can see what's going on with the markets. Here's what else is really interesting. Right down, if you look beneath the charts, these are associated articles that talk about the stock you're looking at. So those sources that you have to get for your stock portfolio, here they are. Well, let's say, for example, we want to see in the last year how this stock did. I can go to historical data, and I can pick a threshold. For example, if I want to see from, let's see how they did the last year. Today's the 8th. Let's see how they did from March of last year to March of this year. So we'll say March, we're going to say March 1st of 2020, and we'll say March 1st of 2021. Well, lo and behold, there is my historical data for the last year. I can go back through all of this and see what the openings and closing prices were for the last year. That's one of the charts that you guys have to put together. Well, here's the trick. It just put it together for you. If you do the old shift print screen function, you can turn that into a graphic and paste it right into your assignment. That's how easy it is to monitor this stuff. In terms of other charts, for example, if we want to go back to some statistics about the stock, for example, we can see, has anybody ever heard the term market cap, by the way? Even if you don't know what it means, raise your hand if you've heard the term. Does anybody know what it means? The market cap basically means, if you talk to people who are in the know in the markets, what is the company actually worth? And when people figure out the market cap, they figure out what the company is making, what they owe, and what their potential future is. It doesn't mean that they necessarily have $8.7 billion in cash, but we can see, for example, the market cap on Beyond back in the end of the year 2019 was about $4.6 billion, and we're doing okay. We've basically almost doubled since last year, so our current market cap is $8.7 billion. That's pretty good. If we look at some of the, I'm not going to get into some of the other kinds of ratios and things because those are things you're going to cover in your finance classes. What you're mostly concerned about is seeing what has happened with your stock over the last year, what it's been trading at. Anytime you are figuring out calculations too, guys, remember this. You always do your calculations based on the price at the close of the exchange, so at the end of the day. There are other ways to do trading, but for purposes of our game, end of the day trading. Does that make sense, guys? All right, I'm going to ask you a question that if you get it wrong, don't worry about it, because it's not on the test. It'll be on the test later. Can you buy a partial share of stock? You cannot. There are ways to invest in partial shares, but you cannot buy a partial share of stock. What that means, guys, is when you're figuring out you have $100,000 in virtual money, when you figure out how many stocks you could buy with it, you're never going to spend all your money. You're going to have a little bit left over. You're going to get as close to $100,000 as you can. But I do recommend using some sort of a desktop-based stock aggregator. The ones on your phone are great, and you can certainly capture images of those on your phone and put them in your report, but this is much easier. Let's just do a search. Will somebody tell me a company that they're interested in? Bueller? I'm sorry, Tesla, that's a good one. By the way, did anybody get the reference I just did there? Has anybody seen? Yeah, Ferris Bueller's Day Off. All right, Tesla, check it out. It's already coming up right away. Let's check out Tesla. All right, look at this. If I wanted to, I could add this to my watch list. In fact, I'm just going to go ahead and add it to my watch list because it's a good stock to watch. We can see from these statistics here that the previous close on Friday, it was trading for $621.44. And the markets just opened here in the United States because it's 9 a.m. on a Monday. And we opened at a higher price per share than we closed at, for example. If we get, for example, down in some of the ranges here, this stock, look at this range. we went from $70 to $900 in a year. That's crazy. Volume means how many people are trading stocks. High volume can be good or it can be bad. It can be good if everybody wants to share of Tesla. It can be bad if everybody's trying to dump shares of Tesla, for example. And again, all of these things, anything you want to find out, let's go back to the last year. Look at this. Wow. So we bottomed out on March 2nd, 2020. Actually went even a little lower than that, 85.51, and we're back up here to $880. Yeah, not a bad gain. We're down a little bit, but I think it'll come back up. And all of these things we just covered, you can get very easily. So that's why I use a stock aggregator to monitor my portfolio. I use Yahoo, you can use Google, you can use whatever you want. But are there questions about why we use aggregators or how to use an aggregator? Questions? You guys feel good about this? Feel good in general? Feel okay? Yeah, I feel okay. All right, so that's my story, and I'm sticking to it, guys. You are welcome to use an aggregator or not. If you use one, however, I do think it'll make things a lot easier for you. Okay, well, guys, let's jump in for today. We're going to go for a good 25, 30 minutes here before we give you some time to work in your teams. And just a reminder of your awesomely named teams, and that's what we're going to be gathering into groups here this morning. All right, guys. Remember I said before there's one time that you can buy stock directly from a company. When is that, guys? What's it called? It sounds almost like a delicious beer, but it's not. What is it? IPO. It's an IPO. IPAs are fuzzy, delicious, and hoppy. IPOs involve spending money. Don't confuse the two. If you have lots of IPOs and you make money off IPOs, you can buy lots of IPAs. That is a primary market. To use an analogy, if you decide you're buying a new Subaru WRX, or a Rex, as Subaru people call them, you're buying it right from Subaru, and Subaru makes the money. If you buy it from a secondary market, which is a used car lot, the used car dealer makes the money. So guys, when you buy directly from a company during an IPO, the company makes the money. When you buy it from a secondary market, there are fees added on. Somebody else is charging you a transaction fee to sell that stock that you missed out on in the IPO. That's the difference between the two. Before we jump in, though, today, guys, who here can tell me what's the difference between a stock and a bond? What's the difference between the two? It's a very fundamental difference. What's another term for a bond? Begins with an L. What is it? What could it possibly be? Oh, I know. A bond. It's a loan. That's right. Talking, you got it. You've been reading your stuff. He knows what he's talking about. Who here can tell me on this side of the room what a stock is? What's a stock? If you own a stock, what do you own? You own a share of the company. What's an advantage on this side of the room to a bond over a stock? Yes. If you're the investor, you're getting your money back with. What's an advantage for the company issuing a bond instead of a stock? Who keeps the control? The company does. Okay, if we go over to the stock side of things, what's a disadvantage for the company issuing stock? What do they lose? They lose control. Absolutely right. That was a death blow to control of the company, right to the jugular with that karate move I just did. So what is an advantage, however, if we issue stock over bond? What's an advantage to the company? It's the reverse of what you just said. What has the company not had to do? They haven't had to borrow money. So if you have stocks, for example, are you required, if your stock is making money, to pay a dividend? You are not. You're required to pay interest on a bond. You're not required to pay interest on stock or dividends, I should say. So, generally speaking, bonds are paid back. Control is retained by the company. Stocks, you're giving up potential control because for every share of stock you sell, the person who owns that share of stock generally has voting power. Remember that stuff, guys. There's reasons why we do vote. And the reasons we do either is because we want to expand our companies. So when we get into secondary markets, there's generally two ways you can go. We refer to broker markets and dealer markets. Generally speaking, if you are buying through stock brokers, people who actually do the trades for you, you're going through national or regional exchanges. The biggest thing I want you to know about this is the biggest exchange in the world is still the New York Stock Exchange. So if you see people on TV with phones from their ear running to do trades, that's a broker market. If we get into a dealer market, what we're talking about are electronic exchanges. Guys, how many of you trade your own stocks? Yeah, you're probably using a dealer market, and even if you're using Robinhood, it ultimately comes back to this stuff. We're talking about the NASDAQ. Write this one down, though. This is one to remember. The first electronic stock market in the world was the NASDAQ. Up until the NASDAQ came out, there was no electronic trading. They made it automated. They made the first electronic stock market. And here's the trick. The electronic stock market itself is publicly traded. So they're even a publicly traded company that manages publicly traded companies. And then we get into OTC, over-the-counter. We'll talk about this more, but how many of you have seen the movie The Wolf of Wall Street? What was so amazing about the way those guys were selling stocks? How did they do it, first of all? Were their stocks listed on exchanges? They were not. These were basically crap stocks that people were saying it's a high-risk investment, although they were packaging it as though it was not. Over-the-counter means you've got stocks that are not listed on any kind of exchange, and people have to find ways to sell them. Those are high-risk investments. So again, to break this down, these are all secondary markets. You've got broker markets and dealer markets. Broker markets are more traditional. You've got people who are actually making exchanges for you. Dealer markets are electronic. The first electronic stock market was the NASDAQ. If you're doing OTC trading, over the counter, you're getting into extremely risky investing. All right, so let's talk about common stock. First of all, if I said I'm going to give you common stock or preferred stock, which sounds better? Preferred. Yeah, I'll get some of that preferred stock. Yes, sir. Well, it's kind of a misnomer, because preferred stock means that you get dividends first, you get paid back first, but you give up your voting rights in exchange for preferred stock. So common stock, if you want control of a company, I would take a note of this. If you want control of a company, you want common stock because you get voting rights. Will and I both own shares in a company. He owns 100 shares, I own 500. I have more voting rights than him, unless my 500 shares were preferred stock. By the way, that's actually cologne from the 1980s. We were so obsessed with money in the 1980s, we literally had cologne called preferred stock. Yes, the big 80s. The decade of decadence, as fans of the music would say, was epitomized in preferred stock. Again, if your company is making money, you can get paid what's called a dividend. And that means somebody is paying you, saying our company made money, so for every share of stock you have, we're going to pay you X amount. I made some big money on Planet Fitness this last year. I made $1.50 because I have 2 shares of Planet Fitness stock. I literally own 2 shares of Planet Fitness stock, and I got repeated dividends of 19 cents. I don't think the tax guys are coming after me anytime soon. I'm not exactly a big-time trader. But they're not required to give you those dividends, but they still did. Well, you could also, instead of paying a dividend, you could reinvest in the company. Well, why might you want to do that? Let's say, for example, how many of you think Uber might be a big investment in the long term? Yeah, well, Uber's not yet profitable. Why are they not yet profitable, guys? Anybody know? Yes.
They're putting all their money back into the company.
Exactly right. They're putting the retained earnings back into the company. What's Uber's big plan in the long run? What are they hoping to create? What's their profit model in the long term? Anybody know? I'll give you a hint. The term human resources. Take the term human out of human resources, and that's what Uber wants. What am I talking about? I'll give you a hint. I'm driving for a while. This is a lot of drivers behind the wheel of Teslas right now. Why are they able to do that? The car drives itself. That's Uber's ultimate goal, is to be able to get rid of people and have self-driving cars. So retained earnings go back into the company. Now, here's another thing, too, guys. Is anybody here a fan of the show Shark Tank? Yeah, it's pretty cool. When somebody likes an idea or invention on a episode of Shark Tank, what do they typically ask the inventor for? We'll give you this money, but is it free? I'm not sure what happened to this chair here. Is it? Maybe I got to drop a couple of pounds. Anyway, what's the deal, guys? When we go into Shark Tank, if they like the idea, what do they want? What do the investors want from the inventor? They want equity. They want to own part of the company. And so technically, venture capitalist is also equity investing. So equity means if you have ownership in the company, whether you own stock, whether you are a venture capitalist, all this is equity. Putting money back into the company is what we refer to as retained earnings. Now, in terms of the way stocks grow, some stocks are considered to be what we call hot stocks. Right now, why is our medical stocks or biotech stocks hot right now? COVID-19, exactly right. COVID-19 has been driving that, but we've got lots of things that have been driving stocks over the years. For example, there's a disease in the continent of Africa that's still running wild. Does anybody know what it is? It's a virus that we've largely controlled in North America. Started in the 1980s. It's fatal if you don't treat it.
Ebola?
Ebola is a good guess. Yes.
Malaria?
That one is also good. I'm thinking one that was sexually transmitted. HIV or AIDS. That's still a big deal. We come up with more treatment for AIDS, you're going to make lots of money because it's still a big deal in some parts of the world. Tech and medicine are risky investments, but they can pay big dividends in the long term. And then we get into what we call income stocks. Guys, why are income stocks so profitable? Well, because they're mainly utilities. For example, how many of you at your home have running water? You have one company that provides you running water in your areas. How many of you have natural gas? Yeah, natural gas heat is fantastic. You probably have one provider of natural gas. These companies essentially are monopolies. And so stocks that involve utility companies, power companies, typically always grow. And the rate of return typically goes up with inflation because when people pay more for power or more for water or more for gas, the rate of return on those stocks continues because the investments are relatively stable. So again, we're talking risky growth stocks. We're talking less risky utilities. And then we get into penny stocks. These are also the ones we're talking about from the Wolf of Wall Street. These are risky. They're called penny stocks because they're typically less than $1. So you got to buy big volume to potentially make money, but you could lose your you-know-what in the process. So penny stocks. Then we got blue chip stocks, and these are companies that almost always are profitable. We typically say like Boeing is a blue chip stock, or Lockheed Martin, or Northrop Grumman, big airline companies. What would you guys say? What is a stock that you would call a blue chip stock? A company that always seems to be profitable. I know one I think of, and all of you probably have part of it with you today. Who am I thinking of? Apple, absolutely. I would also say that generally speaking, Amazon has attained blue chip status because of how profitable they are. Tesla, not yet. They're still too volatile. But a lot of these companies are considered blue chip stocks. So again, the pros and cons of the stock market. If you are a company, you can raise money very quickly. It's a big deal when you get to be at the opening bell of the New York Stock Exchange. And wow, hey, our company is publicly traded now. That's a big deal. It makes you more credible. And the other part of it too, guys, technically speaking, you're still in control of the company whenever you issue stock to a point. You also don't have to pay dividends. Here's where it becomes a problem. Let's say, for example, those of us in the front row here, we're your board of directors. Actually, John, will you turn around and face these guys? You so sit. Right here, we all own shares of stock in this corporation. So we own shares of stock in Kent Tompkins Chicken Shack, and that's your board of directors up there. Guys, in the last quarter, and I'm an angry shareholder. In the last quarter, we've made $6 billion, and we've not seen anything in terms, see how I'm shaking my fist, that's how angry I am. We have not seen anything in terms of dividends. How do you guys feel about that? They're making all this money, we're not getting dividends. You guys happy about this? That's where you say no. Now say it really loud. No! No! We're not happy about this. So what are we going to do with these bums? These guys aren't really bums, but the characters that play are bums. We're going to vote them out. We're going to vote them out of our board of directors, and we're going to get people in who want to do things right by the shareholders. So we vote these guys out, we vote new people in, because we've spoken with our shareholders. These guys have lost control of the company because the shareholders weren't happy with them. You guys would do a great job in reality, so I'm sorry to put you on the spot there. Here's the other part of it too, guys. You actually get taxed twice. A corporation that's profitable pays taxes on that corporation, how do I rephrase this? Corporation pays taxes on capital gains, but they also pay taxes if the stocks are profitable. So you're paying tax twice. And again, capital gains tax means you're getting taxed for profit, and you're getting taxed for the shares of stock being profitable as well. That brings us to a rate of return exercise. My goodness, that happened fast. But that's good because we're going to go through this. Before we do this rate of return exercise, in essence, I'm going to show you how to get an A on your homework. I need to stop for a second because I'm talking crazy today, feeling a little fired up, and I need a question or comment from somewhere out in the crowd. Sorry if I seem a little crazy today, guys. I'm into it. What would you like to ask? Who here has a question or comment for old Professor Tonkin? Yes, ma'am.
What's your favorite Olympic sport?
My favorite what?
Olympic sport.
Olympic sport? Ooh, I would have to say, can I use Winter Olympics?
Yeah.
My favorite is the long jump with the skis. What do they call it? The downhill. That not downhill, but when they hit the ramp and they jump. Isn't that downhill? What do they call it? To see people fly, that's amazing to me. Like that somebody can actually go hundreds of feet in the air and land and not get hurt. That's amazing. What's your favorite Olympic sport?
Swimming.
It would have to be. You gotta love swimming. Absolutely. That's a good question. All right, guys, we're going to go through the rate of return. And I'm going to ask you to have either your laptop or your phone because we're going to do some calculations together. We have $100,000 and we decided we're going to buy 2 stocks. For some ungodly reason, we're going to buy Harley Davidson, which is a brand that has not been doing well, and we're going to buy Ford. So we've decided right off the bat, you know what? We're putting 60% of our portfolio into Harley. We're putting 40% into Ford. So 60% of $100,000 is $60,000. That's how much total we have to invest in Harley. 40% of 100,000 is 40,000. That's how much we have to invest in Ford. We can't buy partial stocks, so we're going to see how we can invest our money here. Let's go through these calculations together. So how many shares can we buy? I'm going to ask you guys to check my math. So we're saying we're buying these on the 1st of October, and Harley is trading for $50 a share. If we divide 60,000 by 50, will somebody do that on their calculator for me? Check my math. We divide 60,000 by 50. Is my math correct? We have 1,200 shares. Okay. Well, we decide we're also going to buy Ford, and Ford is trading for $9.50. If we divide 40,000 by $9.50, what do we get? 42.10. So right now, if we take that though, because we can't buy partial shares of stock, we take 4,210 times 950. Do we get 39,995? We do. Here's the point with this math. Right now, because we're buying at 950 a share, if we divide 40,000 by 950, we know we get 4,200 shares. That does not eat up the entire $40,000 we've allocated. Right now, we have not invested $100,000. We've invested $5 short of $100,000. With me so far, guys. Again, remember this. You cannot buy partial shares of stock. Well, we decide then we're going to sell this stock on the 31st, on Halloween, because we're not superstitious. And right now, Harley went from $50 to $53. So we know automatically we made money on Harley Davidson. How do we figure this out? If we take 53, which is the amount we ended up with at the end of the month, and minus 50, that means every share of stock we own, we made $3. So if we take $3 times the number of shares we invested, which was 1,200, that gets us to $3,600. Not bad. Well, if we take 3,600, the amount that we actually made, that's the money we physically made, and divide it by 60,000. Will somebody check my math? What do we get? Am I correct? Okay, so we got 0.06. Turn that decimal into a percentage. And by the way, anytime you do math for the purposes of the assignments, take out the 4 decimals because rounding that makes a difference. We made 6% on that stock. Not too bad. We got a positive rate of return because we made money on this stock. Well, things aren't as rosy over at Ford. We bought the stock at $9.25. Or sorry, we bought the stock at $9.50, and on the 31st, it's down to $9.25. We know that we've lost a quarter per share, so we already know we're going to have negative rate of return on Ford. If we take negative 0.25 times 4,210, that gets us a loss of $1,052.50. So we lost money on Ford. Now we know we had $40,000 to invest in Ford, but we didn't invest the whole 40. We only could get to $39,995 because we can't buy partial shares of stock. So if we divide $1,052.50 by $39,995, we have a negative 0.026 or a 2.6% loss. Now we want to figure out, because we had one stock that made money, one stock that lost money, how did we do overall with our portfolio? What we do, guys, is we take the total amounts we made or lost and we total them. So, for example, we made 36 on Harley, We lost 1,052.50 on Ford. That means we still made money. We did not lose our bucks. We made money, not as much as we would have hoped. We made $25.47.50. And then we divide that amount by the total amount we invested. And again, we did not invest $100,000. We invested $60,000 plus $39,995. We got a total rate of return of 2.55%. Does that make sense, guys? Let's recap, because this is oftentimes where people make mistakes. Again, when you are designating how much money you want to spend, you might say, hey, we're going to break it out. Let's say you bought 4 stocks, and you wanted to do 25% for 4 stocks. That's easy. You have $25,000 to spend. You're going to divide that by the cost of the stock at the closing price. That's going to give you your number of how many shares you can buy. You cannot buy partial shares, so you take it to the number that you can actually buy, because you can't go beyond. If you have 25.25 shares, you can buy 25 shares. You're going to divide your final profit or loss based on how much you actually invested. People make mistakes in this assignment all the time by dividing by the total that they had to invest and not what they actually did invest. Does that make sense, guys? What questions would you like to ask? I want to make sure you get this. We're going to cover this again in class on Wednesday, or I'm sorry, on Friday. A couple of questions for you guys. How many decimal places should you go to when you do your math? 4. You should go to 4 decimal places. Absolutely. Whenever you do your math, you should be totaling your total investment, not the total amount that you had to spend in the first place. And again, one last time, can you buy a partial share of stock? Exactly right. All right. Any other questions on that, guys? Well, here's what we're going to do. We're going to cover bonds quickly, and then you guys are going to get into your groups. Just very quickly, guys. A bond means that you're taking a loan. If you're a company issuing a bond, you're borrowing you're borrowing money from people, and you're doing so at a declared interest rate. For example, if you're deciding to lend someone money, you want to get paid back with interest, so you're going to decide what interest rate you qualify for. Guys, people with good credit tend to get what kind of interest rates, higher or lower? They get lower interest rates because it means they're better risk. So what interest rate you get is going to depend on your bond rating. We'll talk more about that in our next lecture. If you have a big loan that you're putting out, you might need to put out collateral as well. So, for example, if this company is issuing a bond, what's our collateral? Well, it's our factory, it's our company, it's our vehicles. If it's unsecured, it means that no collateral is required. Either your credit is that good, or the loan interest rate is that high, or you're just getting money from somebody who's willing to take a risk on you. A callable loan means you can pay it off early and save on your interest. Some companies won't let you do that because they want you to make all your payments, and they want you to pay all the interest. So they'll let you pay it off early, but they'll still charge you 100% of the interest. If you get a callable loan, it means you can pay it off early and save some money on interest. A convertible bond means that basically we can get to a point where we're ready to get rid of our debt, and instead of paying off the whole loan, we could say, how about instead of paying off the whole loan, I give you some shares of stock in my company in exchange for paying off the bond. So those are key terms for bonds. And actually, you know what? This is a good place. We'll pick up on bonds on Friday. What I would like you to do, though, for a moment, is to gather into your groups. And for those, I forget, Jake's in whose group? Would you guys mind gathering back with him by the monitor so he can be a part of your conversation? Guys, gather into your groups for a minute. I'm going to give you a little bit of instruction that I'd like you to consider here. So gather into your groups.